most powerful bank in the world has a new chair after one of the most contentious confirmation battles in its history. Kevin Warsh is the new chair of the Federal Reserve, the Fed as it's known. But the Federal Reserve isn't a normal bank. It's not like you can deposit your money there, and you can't take out a home mortgage or a small business loan from it. Instead, it's the bank that sets the cost of money for everyone, everywhere. So the Federal Reserve was started in 1913, originally intended to be a bank of last resort. It's a government entity, kind of separated from the rest of government. I'll explain how later. But it was originally intended to act as this bank of last resort. So think about 1913. We were having all these bank runs, all these economic panics, banks could collapse, people would run at the bank to get their money, and whenever they heard the inklings that a bank was like struggling. They wanted to kind of stop that, to be able to stabilize them in these severe economic systems to prevent a depression. That's like when the economy stays bad for years. A recession is like a few months. They wanted to be able to stop it before it gets to a recession, to stop these banks from collapsing and all these people who had deposited their money from losing their money. That was its original purpose, but it's expanded over the years. And their number one thing you need to know, Federal Reserve can control interest rates. So the Federal Reserve meets about 8 times a year. They have a board of governors of 7, and then they have regional banks that kind of act out the operations for the Fed. They also do tons of economic research. They publish all these papers, and they give the Federal Reserve Board of Governors information so that these economists, these are, mostly brilliant economists, can make decisions about something called the federal funds rate. So like I said, the Federal Reserve is not loaning you or me money, but they will loan a bank money. They will allow banks to deposit their money there, and they set the federal funds rate. So when they meet and they talk about interest rates, they're talking about that federal funds rate. That's the interest rate that they charge different banks to put their money there, or the interest rate they're going to pay banks if they put their money there. Like interest rate for the loan, what they charge banks for that, what they give banks if they put their money there. Because at the end of the day, like at the end of a literal day, banks have given out all these loans, they've taken out all this money, they've made all these investments. They have regulations, some from the Fed, some from the federal government, about how much money they've got to keep in their accounts. And they've also got to balance their balance sheets, like assets, liabilities, everything. And so at the end of the day, they're doing that, and they take loans overnight, like these quick overnight loans from other banks and from the Federal Reserve, or they'll put money in the Fed, or they'll put money in another bank. The Federal Reserve sets the baseline rate, and all other interest rates flow out of that. Now, the Federal Reserve is so important that even the words of the Federal Reserve Chair, because they'll release statements, they'll get the interviews, they release some very ambiguous policy questions whenever they are raising, lowering rates, or keeping rates the same. Even those words can affect the stock market. Even those words can affect inflation. So many Fed chairs you'll see, if you ever try to listen to one of them speak, they speak in vague ambiguities, complex terms. And that's a criticism that they get. But they do that because they know that their words have such power. So this interest rate, why would we want interest rates to go up? Why would we want it to be more expensive to borrow money? So the Federal Reserve, and economists in general, have these two concerns, but the Federal Reserve has these concerns in its charter that they are concerned with maximum employment and keeping inflation low and stable. Now, you don't want no inflation. That's also not good for the economy, but you don't want high inflation. So when inflation is high, the Federal Reserve will raise their interest rates. That's called contractionary economic policy. It's designed to cool down the economy when it's heating up. So we hear words like contractionary, expansionist, cooling down, heating up. Those are all meaning the same thing. They're just important for you to know because you'll hear them all the time. If you pay attention to the markets and to the news, you'll hear those terms. And so they raise interest rates when inflation starts heating up. They lower interest rates when inflation's down, but they want to spur economic growth. Now, the Federal Reserve got a lot of heat for their interest rate decisions after the COVID-19 pandemic, mostly because people thought they might be a little too late to have engaged in contractionist policy to stop those interest rates. But in general, they were regarded as a pretty steady hand in that time period. Now, many people have put a lot of pressure on the Fed, made it really political, which is not good because you want it to be independent. You don't want the Federal Reserve to be swayed by politicians' interests in getting elected. Because if a politician has an election in a few months, obviously they're going to want you to drop interest rates because the immediate effect will be more economic growth, which they can cite and job numbers. But the longer term effect, even the medium term effect, is that that's going to heat up the economy, could trigger more inflation. So you want the Federal Reserve to be independent of that. There's lots of studies about other countries that have central banks. It's better when they're independent. It's much better. And so right now, we've embarked on a period where inflation is heating up again. They'd gotten it under control over time. What's called a soft landing. People regard the last Fed chair, Jerome Powell, as achieving a relatively soft landing, where we were able to kind of get inflation relatively under control without totally pulling the brakes on the US economy. But now inflation has started heating up again for a variety of reasons. Inflation started heating up because there's so much AI investment, like all this money's going into the economy, it's making jobs, it's like technology, but also that's like more money into the economy, you know? Like when a bank gives out a loan, that like then goes and becomes like a bunch of jobs. Those jobs then like fund other businesses. You see how like it just expands. Like whenever money goes into the economy from these banks, like especially if like it's coming out of like they're taking it out of the Federal Reserve, like where they were saving it and like putting it back to the bank, more money, basically more money. Money's a concept. And so right now inflation's going up because it's AI investment, also because we're in an oil crisis. The war with Iran has triggered inflation. Oil pressure like triggers inflation across the board because what's in everything? Oil. How do you move anything? Oil. So oil, very inflationary if its price goes up. So now there's a lot of pressure on the Fed. A lot of banks, like commercial banks, also issue guidance about what their researchers, because they have research departments who all they do is just release guidance about what they think of a stock, what they think of interest rates. A lot of these banks think that the Fed is going to raise interest rates. Now, a lot of debate about whether that's a good idea or not, but inflation is like the worst thing that can happen to an economy. The worst thing that can happen is actually stagflation, which is an economic thing that you want to avoid because that's when unemployment goes up and inflation goes up, and it's not funny actually, it's like terrible. But inflation is really bad. If your money's not valuable, then like what is the point of a job if what you're getting doesn't mean anything? So inflation is going up, and so there's questions about whether the Fed will raise or lower interest rates. Most banks think they're going to raise rates over time, but there's a question of independence because the government is putting lots of political pressure on this entity that's supposed to be independent. And so there are these Federal Reserve Board of Governors. They meet 8 times a year. It's the like 7 members of the bank in DC, and then a rotating set of members from these regional banks that act as like arms of the Fed to do different things, to actually do the lending, to actually do the saving, to actually like research and give information. And it's a rotate. I think the New York governor of that one is always part of it, but then the other regional banks shift. And that's supposed to like intend to make this entity accountable to the people too. So like the Federal Reserve, like the main part of it, that like whenever we talk about the Board of Governors, those people are appointed by the president, but confirmed by Congress. So like Congress is supposed to be the people's voice in like determining that. But then these regional members that sometimes get a vote are decided by like business, local business, and they're more accountable to like people. People run these businesses. And so the Federal Reserve, what you need to know at the end of the day, controls interest rates. Interest rates control the amount of money in the economy, the value of money in the economy. And so that's why it's so important. And that's why it really needs to be independent. And that's an open question right now.